Good afternoon and welcome to Topstep's Trading Foundation presentation about fundamental analysis and how fitting it is on today, Wednesday, January the 26th, happens to be FOMC release day, one of the more important releases about fundamental analysis and information. Hello, gentlemen. It's good to see you as always. How are you?
Good afternoon, Hogue. I am amped for the Fed today. Should be fun.
Going to probably be some fireworks, that's for sure. And we'll probably be right about finished with this presentation, and maybe we'll be able to watch the reaction as the release comes out. We'll certainly announce what it is. It's always a pleasure seeing everybody and where you're coming from. Wherever you are, I hope it's warmer than it is here. This morning, it was a balmy -5. We're up to a sweltering +7 degrees now.
Yeah, it was quite something. My dog won't wear the boots, and when he goes outside, he prays for death pretty much. So there you go. One announcement too. We compiled a list of the books so far. JD, do you want to talk a little bit about that? I was thinking maybe all you guys can see the Q&A module, right? JD, is it possible for you to post in the Q&A so it just kind of stays there, or?
Yeah, I can do that. I'll throw it in the chat too, real quick. Full disclosure, we don't profit in any way from the sale of these books. You could find most of them probably at your local library if you want to check them out first before purchasing. But I put a purchase link for Amazon in there for all these titles also.
Very cool. And then at some point, we're going to share, not sure exactly how we're doing this, but we're going to share another doc that you guys can edit and throw in any books that you find. Then we'll probably give them a light look over just to make sure no one's posting things about ancient aliens or whatever, and add those to the list as well. So take it away, Hogue.
All right. Thank you, gentlemen, and welcome everyone. So again, fitting that we're doing this today, fundamental analysis. I got to introduce myself as always. My name is John Hoagland, the senior middle-aged performance coach. Coming in just a couple of weeks. It's 39 years of futures industry experience for me. Been traded on the floor of the Mercantile Exchange for over 20 years, as well as other exchanges. Come from a long line of traders. My dad and brother were also traders. Dad was on the floor of the Board of Trade for 40 years. I had to walk out of the trading pit in 2009 and start to relearn trading on screen. And in 2011, I hooked up with Topstep. Knew we were going to have the opportunities that many of us here in Chicago did to learn about futures trading in a safe environment. By working on the trading floor, I started as a runner and worked my way up, got hired as a proprietary trader, funded my own account for a while, was a filling broker for quite a long time, and finally had to walk out of the pit. So since 2011, it has been my honor to have the opportunity to talk to and work with thousands of traders from around the world and to help try and help them improve their performance. And I hope that that is true for all of you. At Topstep, our goal is really for your success and to help you improve your life. So let's jump in here. Fundamental analysis, of course, we're going to define it first. It's a method of evaluating a security that entails attempting to measure its intrinsic value by examining related economic, financial, and other qualitative and quantitative factors. Fundamental analysts attempt to study everything that can affect a security's value, including macroeconomic factors like the overall economy and industry conditions, FOMC release today, and company-specific factors or product-specific factors like financial condition management of a stock. For instance, you make sure that the stock you're buying is in good hands. This method of security analysis is considered to be sometimes the opposite of technical analysis. There's going to be conflicting information that you're going to get from fundamental information that may not agree necessarily with your technical analysis. And get this, many economists suggest that neither fundamental analysis nor technical analysis is useful in outperforming the markets. And what are we doing here? Fundamental analysis really comes down to the law of supply and demand. We've got price more expensive with higher demand, the price versus quantity versus supply. Their market is always going to find that area where two-sided trade can occur, and that's where really true value is. When we're talking about a physical product like crude oil or corn, obviously these are products that pretty much everybody uses. There's, as we can see in crude oil, especially lately, we're seeing questions as to whether we're going to have enough supply. Demand is increasing, supply is decreasing, price is going up. There's some basic rules regarding supply and demand. Rule number one, if supply increases and demand stays the same, prices should go down. If the supply decreases and demand stays the same, the price should go up. Number three, if supply stays the same and demand increases, price should go up. And if supply stays the same and demand decreases, the price will go down. It's all part of the auction process. We talked about the auction process a day ago, and it's, when you think about it, if you have a whole bunch of snow shovels in July, you're not going to have much demand. If you want to sell them, you're really going to have to lower price. But come wintertime, when everybody needs a shovel, demand increases. If you don't have the supply, you're going to miss out on some of those prime sales. Why do we even think about fundamental analysis, even as day traders in futures, Forex, whatever we're trading? When you think about the end goal of performing fundamental analysis is to produce a value that an investor can compare with a securities or a product's current price. The aim is figuring out what sort of a position to take with that security. If the security is or product is underpriced, you're going to be buying. If it's overpriced, you're going to be selling short. Seems simple, but just like any economist, any technical analyst, there's always going to be situations where there's things that we're missing, things that we don't see, things that we do see. It's all still just part of creating that hypothesis about what direction the market is attempting to go, how good of a job it's doing getting there, paying attention to the auction process, paying attention to fundamental information as far as supply and demand is concerned, and looking for good trade locations. Really, the brunt of it is finding areas where we don't have to risk a lot to find out we're wrong, and where we have big opportunities to profit. We're looking for asymmetric opportunities. Why is fundamental analysis important to a short-time futures trader? Well, I kind of view it as similar to the reason why we think, and I think, that futures traders should be not just focusing on the short time frame charts. We should be looking at the longer time frame charts. We should be looking at what the market's been doing for over the last months or weeks or days. As a day trader, it's important to know that information, or to be able to hypothesize with some accuracy that information to give us ideas on which side of the market to trade from. If we're trading crude oil, we've probably been much more successful over the past couple of months waiting for opportunities to buy the market when it appears weak, knowing that fundamentally and technically the market has been moving higher over time. How good of a job is it doing? volume and open interest, which is something we're going to be discussing tomorrow, as well as a little introduction to Delta, is to finding those good opportunities. If you're an institution or a producer or a user of any of these products, thinking more along the lines of physical commodities, it's easier to kind of wrap your head around what's a producer and what's a user when we're talking about physical commodities. Of course, it's important for them to understand fundamental analysis. If I'm a farmer and I've got several thousand acres of corn, and I'm going to certainly be paying attention to the weather. I'm going to be paying attention to the crop intentions, crop progress, all of that information. And I've got a whole long list that we're going to go through and relatively quickly. Today's presentation shouldn't take too long. Of course, questions are always welcome. But it's also important to the trader and or the investor, of course. Any speculator in a tangible commodity is certainly going to have their finger on the pulse of the fundamental information. What is going on with the growing season? What's the foreign crop looking like? What about South America? They have an opposite growing season. Is it a good growing season? Are we selling plenty of grain to other countries? What does it look like if you're a farmer right now, you're thinking fundamental information for your crop in November, October, November, December, when it comes, when it's harvested. What are you going to be able to get for it then? What are the nuances in fundamental information telling you? Of course, it can change. There's a lot of factors when you were looking at agricultural commodities, grains, meats, energy commodities like crude oil and natural gas. Those are all very fundamentally run as far as price is concerned. But is it that important for day traders or futures traders? Of course, anything that can give you information that gives you a little bit of an edge, or better information, or information that others might not be looking for that might be more important, is eventually going to be very important. Okay. Now this list of releases is not changed very much. This has been put together a few years ago. And as the years have passed, it seems even more important to be aware of fundamental information from foreign countries as the world has become a more one global community. Any of this information from any country can have an effect on the marketplace, depending, of course, on what you're looking at. When we're looking at financials, we're looking at treasuries, we're looking at anything that stores value like gold. These releases are going to be very important. You can see one that's on there right now, and that's the FOMC announcement. So any government report regarding the economy or agricultural commodities. We have FOMC announcement today, fundamental analysis. What are they going to do with interest rates? The cost of money. The cost of money is going to have an effect on everything. What are their plans for the future? 1:30 today, we're going to find out when Chairman Powell begins to speak. The GDP, that's tomorrow. Tomorrow, we've got another huge fundamental economic release. Unemployment situation, job creations, jobless claims, new home prices, existing homes, interest rates, of course, commodity prices, volatility, FOMC announcements like today, construction spending, money supply, all of these things are hints as to the health of the overall economy, consumer credit, personal income, household spending, retail sales, US Treasury, leading indicators, what we used to call on the trading floor, misleading indicators, durable goods, of course, consumer sentiment, anything in the news, headline risks are always out there, and they're usually going to contain fundamental information. Earnings per share, revenue, shares outstanding, just a few of the long list of fundamental information that will affect stocks, economies, just about anything. Agricultural releases, planting intentions, crop progress and production, exports, both what we're exporting and what foreign countries are exporting, cattle on feed, talking about grains, cattle eat a lot of it, USD supply and demand. That's basically what we're talking about. USD tells us. Weather, of course, is going to affect agricultural releases, expected yields, both domestic and foreign crop production and exports, of course. How about the price of buying a farm? How about the amount of grain that's currently in store? Even technology is a fundamental part of the agricultural commodities, of the agricultural fundamentals. The scientists are constantly trying to improve the plant. Let's say it's corn. They're trying to improve the plant by creating shorter plants and having the plants expend more energy on the ear. A bigger ear, better yield per acre, better for the farmer. Who knows? But that technology is something that's always lurking, and when changes occur, they're going to affect price fundamentally. How about meats? Grain prices. You're gonna feed your cattle some grain. You're gonna have to buy it if you're not growing it. Cattle on feed reports, hog and pig reports, weather, of course. I don't know how right this is, but I was on a motorcycle trip and I was in the plains of Wyoming on my way out to the mountains, and it was a drought year. It was 110 degrees out, it seemed, and there hadn't been any water in a month. There was a lot of cattle that was suffering out there, and of course that is going to affect the supply. Cold storage, exports, technology, of course, foreign production, of course. These are just a few of the number of releases, economic releases, government releases, that we have to keep an eye on if we're going to really be focusing on fundamental information. Again, how useful is it for futures traders? There are a number of futures traders, and myself, Jim Dalton, a lot of futures traders want to know when these releases are coming out. We don't necessarily need to know how they come out. Jim Dalton says he doesn't look to see what the releases are. He responds just by what the market is telling him. He's, the godfather of market profile. So if he's that good, God bless him. But we generally want to know when these numbers are coming out, and how we are going to be able to, if we're going to be able to respond to them. Here's an important safety tip. There's the buy the rumor, sell the news rule. Because fundamental information might mean price should go higher, for example, the positions of those expecting the move may initially cause price to move in the opposite direction. Buy the rumor, sell the news, from what I understand, is something that's been floating around the Chicago Board of Trade floor for decades, if not a century. When there's expectation for a release to be saying that supply may begin to suffer for some reason. The traders, investors, they're going to, in short time frame, medium time frame, probably be looking to take advantage of when that number comes out or when that release comes out. If it comes out right, if it comes out the way it's expected, it's going to lower supply, which should drive price higher. So we're all going to be positioned for that expectation. When the number comes out, if it's different from what it was, that can, of course, gyrate prices pretty well. If it comes out as expected or even better than expected, the fact that multiple time frames are already positioned for the move to the upside makes it so that, well, creates a situation where the available buyers are already in the market. So you're going to have the release come out. We used to see this in the trading pit. We'd have a release come out. Everybody'd look around. There's nobody left to buy it. All those buyers that are holding those positions start jumping over each other to get out. It was something to watch for sure in the trading pits, and it's something similar happens on screen. I think it happens a lot faster on screen. We may have something that comes out today or with the GDP tomorrow that says, everything's good, we should move higher again. But if too many timeframes are positioned that way and there's nobody left to buy it, the initial move will be to the downside, the opposite direction. It's been my experience that taking positions into fundamental news releases has been sometimes wildly successful and sometimes painfully unsuccessful. I've taken my share of, positions, large positions. According to me, they may not be large positions to some others, but I've had some positions into some major economic releases. And again, I've had wonderful, tremendous success on some of those days and terrible disasters on some of those days. And looking back to take the P&Ls of those days, add up the successful ones and subtract the not successful ones. Over the years, I've come out about even. And therefore, I choose not to play. It is okay to choose not to play. There is huge risk. There is, yes, there is opportunity there, but to believe that you're able to put a strategy together that's going to be consistently profitable in this regard you're going to have a hard time doing that because this is fundamental information and because we don't really know the positions of those that are standing around us, sitting around us, or playing on screen. It's going to be very difficult to find any consistency with holding positions into major economic releases or any of those fundamental releases that we just went through. I know that there are those that will let the release come out and will respond to what the market tells them afterwards. I'm sure Jim Dalton is one of them. I've been known to react to information after the fact. I think you're better off having a reliable or somewhat successful strategy by doing that than actually holding the position into the major economic release or industry release, whatever it is. The volatility that can be created can offer some big opportunity. There are those that thrive on volatility. I am not one of them. When the market is too volatile, I've been too active and had some pretty bad days. So now when the market becomes volatile, when something changes the market very quickly, I have to make sure and stay patient, wait for the right opportunity, wait for some sort of structure to tell me this is an opportunity to limit my risk. That's the most important thing. There's a lot of, people, traders talking on Twitter and Facebook about, if this is not your market, if volatility is not your market, you're better off, relaxing and waiting for the market to align with the strategy and the skill level that you have. Most of the time, our markets are not this volatile. And if you've never had the opportunity to trade in volatile markets, you're probably going to be seduced into over trading. You're probably going to be thinking, wow, this is too much information. This is too much opportunity. The opportunities are too big. I've got to take advantage of it. And quite often we get taken advantage of. And so, think about you're funding your own account, whatever it is. One bad release and you can be sidelined for quite a long time. It's not something that we should take lightly. We're getting pretty close to the FOMC release right now. We're going to make sure and take a look at that. If we do have questions, we can go ahead and take them, but I want to make sure and let everybody have an opportunity to see what happens here with at least the equities.
Yeah. Hey, Hope, do we want to like pull up? Do you have like an ES chart or something handy?
Yep. And here we go. Okay, this is a 30-minute chart. So we're going to see if there's any real reaction. Now, this is something that we would expect on a day like this, is a smaller range and a range bound day. If you were listening to the forecast this morning, one of my main hypotheses and things I was thinking this morning was, if I do take trades today, I want to be really reasonable with profit targets. Not going to fall in love. I'm not going to see any huge moves this before the FOMC meeting. So we're seeing the market pretty much range bound and centrally located.
Yeah.
This
Hope,
is
there a way to pull up a dome there as well, just to show them how much this is going to clear out right now?
Of course.
So probably already there's not going to be anywhere near the liquidity there is earlier in the day. This is one of the reasons why you don't want to be trading around the number. We'll see if we can get this up here. Okay. You can see how thin that is already, but as we get closer to this 1 o'clock, it's really going to thin out. It'll probably
we're on
pretty far.
Double and single digits. Whereas normally we'd see bigger double digit numbers and even, 3-digit numbers.
All right. We got 50 seconds.
Dun, dun, dun.
I know, right? This is always get my heart pumping when I was trading. This and unemployment.
This is in the pit because there was like almost the fear of physical damage. You stand there and you could feel your hands and feet getting colder and colder because your body is pulling all the blood into your major muscle groups and into your internal organs because it is getting ready for a fight. We used to grab the guy next to him with my freezing cold hands, and he would grab me back, and we were both the same way. I can almost feel it now.
All right. Got 6, 5, 4, 3, 2. See how thin that is? 1. All right. Now the tape readers.
Single.
Yep.
It's
going up. So right now you're seeing like tape reading algorithms go at it. We haven't even read what's in the thing yet.
Well, there's no change in the rate. So initially that looks
Oh.
like the knee jerk is to the upside.
Doesn't it feel like, this is totally anecdotal, but it just feels like with the Fed, there's always, it reverses that knee jerk reaction. I still wouldn't want to get in there and fade it.
It does a lot. I mean, it got within just a few ticks of the regular trading and extended trading hour high we put in earlier, and is now coming off nicely. There we go. There, you got to fade the knee jerk. Back to point of control.
What we can say here without even reading it, just because this hasn't been a massive move yet, it might move more, especially, with the Q&A or whatever else. There probably wasn't anything hugely unexpected, or else you would see just a face ripping move right here.
Yeah, and we're we're still waiting for the Fed chair presser in about a half an hour.
And that's kind of what moves things. It's very rare. They only change like a few words along the way. They don't like to leave things uncertain, right? And it would be highly unusual for them to unexpectedly raise or lower rates. Usually they really jawbone that ahead of times, just so there isn't too much volatility. But still, look at how thin that is. Like, you don't want to be trading here right now. If you're a longer term swing trader, you have to hold through these things by nature of it, because there's one of these every month. But if you're a day trader, I mean, unless you're Jerome Powell or something, you don't know what's going to happen next. You should never carry a day position through something like this.
Now we're seeing the move.
Okay, well, I'm gonna go dark for a second here and go start to read about this a little bit. And then JD, do you want to, if you're there, you might be getting a glass of water or something. Do you want to ask any of the questions in there or talk more about them while we do this? Oh, JD could be out.
No, I'm here. I was
you're here?
putting some stuff in the chat. Yeah.
Well, let's just talk. This is riveting entertainment right here. I'm gonna go
tech up looking for headlines.
Yeah. Let's see what we got.
Look at the offer.
Looks like we just have the one question, Hogue. Do you ever use the Farmer's Almanac? And if so, how do you use it?
I don't. It's been a long time since I've been involved in trading in grains. So I think, I've always viewed it as more entertainment. I couldn't tell you if there are grain traders that do depend on that at all.
I mean, there's probably much more sophisticated ways. With commodities trading is one of the most sophisticated realms as far as the power of information, right? I think that you talk about data sales. I wish I knew more about this story, but there's some car company, let's just say it's like Ford or GM or something, that was introducing like smart windshields with the idea that it could make the driver's transportation better by knowing how to adjust depending on the rain, humidity, everything else through this windshield. But then they could also sell the data for millions and millions of dollars to commodities traders, because you have hundreds of thousands of cars out there that are like miniature weather stations. That's valuable data. So
why didn't I think of that?
I know. Well, it sounds like something I would think of, but I have no idea how to implement it, I'm going to go back and just answer out loud or give some more thoughts on a couple other questions we had. One is sort of like this, is Nicholas asked, like, how would you expect higher interest rates to affect equities, for example? Well, economists love to speak in timeframes: short term, medium term, long term. If they're in the simplest, if rates were to rise unexpectedly, stocks would go down. And especially the ones that are more sensitive to that. So like the NASDAQ, things that are hoping for bigger profits in the future. Now, the important caveat there is unexpected, right? It doesn't matter. And this is a thing to remember for all numbers, because I think a lot of newer retail traders, say unemployment or something, a unemployment number that comes out will be good, like a really strong number, and they'll be like, oh shit, I got to buy equities. The actual number doesn't mean anything. It's all about the what were the expectations before there. So before unemployment or any of these numbers, if you're going to trade around them, go to a source and get what they'll all have a consensus expectation from like all the analysts and banks and stuff like that. They'll have a whisper number, sometimes like the rumors on either side, and what the high and low predictions were. And what we would always do when we were trading unemployment with the spreads is like we would just cancel down. I would write those numbers down and sticky tape them to the screen because we would have orders in way off market. And if it came outside that band, I would just cancel all right away because then that's going to be a significant, probably one-way move. But to go further on interest rates, so it's all about the expectations. In the longer term, I've seen a lot of research recently, and you can read about it. It's been kind of hot on the interwebs that just on historical stock things, rising interest rates have not been as negative for stocks as it would seem everyone thinks. Like if you look at the last rate rising cycles, now there's correlation there because usually raising rates means that the economy is humming along nicely. So, but I don't think it's automatically a bad thing. And then Ryan asked a question about, what would happen in a pro or funded account if a headline news came out, something random but impactful that would that be like a rule break? And what I said is, yeah, if you broke your loss limit on it, but that's why it's so important that you need to set your stops. And two, I don't know how many of you are familiar. Many of you are, but I'll say it with the concept of slippage in that, and this is something that's worse in live markets than a simulator. So it's another reason that trading on a simulator can be easier. Just because you set your stop somewhere, especially a stop loss, doesn't mean that you are not, there is nothing in the Constitution that says you need to get that price. All right. When it runs through, when it trades that price, your computer is going to try and fire that order as fast as possible. But there's a lot of other people doing that too. And there's got to be a bid there for you to hit. So depending on how fast the market's moving, you can lose more, sometimes significantly more, if the market's illiquid, like we saw there before the number, by using a stop. So one important actionable piece of advice is if you're in something like the combine, never set your stop like $1 short of some limit.
No.
Give yourself room there.
One other warning about stops is if you have a stop limit, in other words, the stop limit can only be executed at the price that it's placed, but it's not guaranteed to be executed there.
Oh God, that could be a disaster.
Price comes down here and there aren't enough bids to absorb the stop at that price or any market orders that hit the market before that is executed. This stop will just become a resting sell order and leave you open for all of this loss. So one other thing about stops is make sure you're using stop market,
yes,
not stop limit.
At the company I work for, I assume that other platforms have these, but we had proprietary software where it was like you would set your max puke levels and stuff like that if you're willing to go 10 ticks or whatever else. And I've seen people lose a lot of money by setting their puke at 5 levels or 10 levels, and then something happens and it goes through it and everyone's just screaming, why am I not flat? Well, dumb, you didn't ask it to. So market. This is a fun question here. Hogue, how many screens do you use?
Well, I've got 3 computers here. I have 3 on one computer, 3 on another, and 2 on another.
Yeah. I think the answer to how many screens to have is you got to be within what your budget is and what you're doing first. But like if we're talking about the optimal number of screens, I would have a dedicated trading computer, and then which only like a computer that only runs your trading software and that you do nothing but trade on. And you don't have to have that. I'm saying we're talking ideal situation. Then beyond that, a second computer where you have your charts and your Twitter or whatever else. That's what happens at prop shops. And how many screens do you need? If you're only trading a few products, you don't need more than 2 or 3. If you're trading a bunch of products, like we used to trade the whole yield curve, so we'd have like 10 or 12. But I want to use the right language here, proper language. You don't want the number of screens to become some sort of macho posturing, right? I used to see that. I think sometimes like traders who would measure their self-worth and the number of screens they have or make them seem more important. And it became this sort of like arms race where you would see people who like were not particularly great traders and suddenly they have 24 screens and they look like they're like in a friggin' half dome of 400 charts. It's just like you can't look at all that. You're one person. You have 2 eyes and they follow each other. All right. So you don't need a retail trader who's traded a couple products probably only needs 2 screens.
Yeah.
Or 1. Like you can do it, make it work. Steven asks, how many tick slippage on the NQ should I expect on a typical day with average volatility? Well, that's the thing with slippage. On a typical day, I wouldn't expect much at all. Where this comes into play is the unexpected. So this is a tough question to answer.
Yeah, because it's contextual. We all know that there's retail traders that are probably entering and exiting at similar areas. So if you have stops where there's a whole bunch of other stops, your slippage is going to be greater. Look at the ends of 30-minute bars. You're probably going to have a pile of stops there. Your slippage might be a little bit more in that regard. The NASDAQ is, let's bring up the dome. Let's see. It's probably even thinner than normal right now. I would imagine there was some pretty serious slippage right after that number came out.
Here's the best advice I think I can give on that is the only time this is slippage is likely to be catastrophic. Now, I could be proved wrong at some point in this, is if you are trading through numbers because the liquidity is already drained out of the market. It could also happen if you're trading like overnight or on a holiday or something like that. If you're only trading when liquidity is good, even if some unimaginably bad headline comes out, if you have your stop order in, you may get some slippage, but it's not going to be catastrophic because it's not like the entire market is going to instantly internalize this. That would be my thought on it.
If you look at the NASDAQ here, I mean, the bid and offer are 2 points apart.
Yeah. Well, I wouldn't be trading now.
No. But let's say you have a sell stop here and it finally gets here and there's an execution there and the bid is down here. Oh. That's where you're going to get taken out. You got a better fill. Look at that. That's not going to happen in a live account.
Yeah. That's like the definition. What Hogue did there is like the definition of the sim advantage. Yeah, Justin says he had a slippage of 3 points. Yeah, that's totally can happen. I'm thinking more of like, I feel like the slippage that's usually going to hurt you is I'm thinking, much worse than that.
Yeah, a flash crash.
Oh yeah.
That, we can't worry about that.
I was working nights at that point, so I was asleep and I just got a text from my partner who was working days, who was like the clerk, we were rotating back and forth, and just said, he was from China and he was just starting to learn English. And he just said, like, "Hi Jack, the market's crashed. Don't bother coming in tonight."
Oh no.
So, yeah, apparently it was quite the ordeal. I just had to see it later. Ryan asked, just checking, I didn't realize the limit order could hurt you so bad. So let's say I set my brackets on Trade-Evade and my entry is a stop limit order. Then maybe I'm just being an idiot. TP. Okay, stop loss limit. Take profit or stop loss is a limit order. Is that correct? How would you recommend I set the bracket setting up to be safest?
Say that again. Sorry about that.
Here, my mind might be mush. I feel like I'm missing something here. Okay. So let's say I set my brackets up a Trade-Evade and my entry is a stop limit order. Then your take profit or stop loss is a limit order. Is that correct?
Yes. Yeah, your risk is a stop, your profit is a limit order.
Okay. How would you recommend I set the bracket settings to be safest? And he adds, not points wise, just so I don't get jumped, essentially.
Oh, well, in a market that's moving like this, if you have a bracket that's too tight, the market can actually beat you to the level. So let's say, you have a bracket that you just took here. I just bought it. Let's say you have a bracket that you just bought it here and your stop was here, but the market moved too quickly for the market, the stop to get sent to the exchange. So what happens then is you're long, your platform sends the order to the exchange to put in your stop, but the market's already through your stop. So that's going to get rejected at the exchange level, not the platform level. So what's going to happen is you're going to be long here. If the market beats you to where your stop is put in and the market is already offered below that, the exchange is going to send them a message back to your platform and say, sell stops must be below current price. So that's one way that you can kind of put yourself behind the 8 ball that way. But there's, if your strategy is that way, you're going to run the risk. So part of it is, making sure that your stops are not going to get beat to the market, which, in an extreme case, the market might beat you to your stop. I've seen it even happen in the S&Ps.
I have an important caveat to say right here. I was just thinking about, and this is just another reason you should really stay away from super thin markets, is from what we said so far, you might be thinking, if I can get hurt so bad with a stop limit, why is it an option? What's the advantage? Well, there's a downside to a market stop too, which is if you're trading a really thin market, like around the night open, overnight, or in something like this, the market stop will puke to wherever the next bid is, which could be in that instant way below where the price would clear. Right. So like, imagine in like a imagine there was a whole point gap in, say you're trading bonds, so there's 32 ticks or whatever. Say things go completely wide, or you're trading a super liquid contract, you could find yourself in a situation where there's just no real bids or offers, and you puke all the way down to some bid that's way off the market. And I've seen, I saw a guy once, like, I think made like 50 grand in a half second on like one lot of 7-year bond cash. So someone on the other side just lost 50K in a second on one lot of 7-year bond cash, right? So
I've done that.
you don't want to do that too often,
No.
but that's what can happen there. So in like thinner markets that you don't trade them, period, but like either way can hurt you with the stop losses.
And another, reason that you might choose a stop limit is for an entry into a position. You put a stop limit in. If you don't get filled at that price, you can cancel it. So that way you're not putting risk, adding risk if you're already in a position using a stop limit. If you get to a place, if we get here, I want to buy it, but I only want to pay this price. If you don't get it, cancel it.
Mm-hmm. Here's a really good question. Stephen asks, when you say that scalpers do not do well in the live funded accounts, what is your definition of a scalper? A person trying to take profit off of 10 ticks, or a person in and out of a trade in under 60 seconds, but has profit in the hundreds? So I've had to look into this a lot. We don't necessarily have a strict definition of what a scalper is, and we're not against people that are necessarily trading that way. I'll tell you what we do see from our data that is insane is that I don't necessarily know what they're doing to trade, but we have people that are trading thousands of NQ contracts in a day, like 2,000, 3,000, 5,000 NQ contracts in a day. And they put up, they'll make, say they make $3,000 in a day, and they also did $3,000 in commissions, stuff like that. When you look at it, it's very clear that this would only work in a simulator. In the abstract, we're not against people holding for short amounts of time. It's these huge outliers of people that are essentially, JD, what do you remember what like the common, we kind of figured out what one thing people were doing with the stops and take profit they were setting?
I'm not sure I recall what you're talking about.
I'm gonna have to go back. I'll talk about this more tomorrow. I got to go talk to Dan Hodgman real quick because he's more involved in the risk management side, and he can tell us what we've seen people doing. But I guess to answer your question, we're not against scalping. We're against super high volume. Yeah, if you have 100 trades a day, that's fine. When you say 100 trades in a day, do you mean like 100 round trips with how many contracts? I think that's probably fine. I mean, are you trading, how many contracts are you trading on these? So 100 round trips, how many contracts are you trading? Okay, yeah, that's fine. That's probably fine. Like if it was, when you start making, I mean, just what's the NQ volume for today right now? This is another thing with the sim difference.
NASDAQ volume 620,000. That
Okay.
includes the overnight.
Okay, so 620,000. Say that somebody was in like 150K account where they can trade 15 contracts. So we see stuff like this. I'm getting out my phone calculator here. 15 contracts round trip. If you did 100, so 15 in, 15 out is 30, and then times 100 is 3,000. And what do you say the volume was in the NQ Hogue?
620,000.
620,000. So here's the math you got to start doing. So that would mean one single trader accounted for 0.5% of the entire, one single trader at Topstep accounted for 0.5% of the entire volume of the NASDAQ futures market. Now let's take this to extreme because we've seen this too. Let's say we have, and we do have this in the combine, 10, 100 people doing this. 100 people are doing that. Wait, now 100 people. Let's do that. 100 people are doing that in the combine. 300,000. Suddenly we're up to like 40, 50% of the entire NASDAQ volume. And you can do that in a sim. Is that remotely possible in the real market? Absolutely not. It's just impossible. So that's what we have to deal with, and what makes the sim kind of difficult for us to deal with. If anyone has any questions about that, feel free to go. But yeah, less than 200. I don't think there's a problem with that. I think we answered, Andre. Just another question. What's the advantage of trading under an LLC? I think as an individual, you're not allowed to anymore. I think I heard. The company, like trading companies, are usually LLCs.
Yeah, you can't have an LLC on your account name.
That is 100% correct. If you're to open a retail trading account with a brokerage, you cannot open it under an LLC. You'd have to open it under your name.
Cool stuff. Well, we have expanded the questions there. Happy to throw it over to you, Hogue, if you have any parting words of wisdom.
Yeah. Join us tomorrow. Volume and open interest and an introduction to Delta. Fundamental information is occasionally helpful and important. But keeping track of the auction process to me has been, one of the most important things that I've learned. And the open interest and volume and the Delta tomorrow should be very interesting information for a lot of you. As for today, we still have Chairman Powell ready to speak here in just a couple of minutes. So be careful out there. We'll see you in the trading pit here shortly.
Awesome. Yeah. And then I guess there's Topstep trading hour today at 2:30.
Yes.
Yeah. Not sure what the sign up information is there, but hope to see some of you.
We'll see you then.